All right, welcome to the deep dive. I got to say, looking at the market lately, it's been a little bumpy, hasn't it? And I bet that's on a lot of your minds, especially if you're running a mid-market business.
Definitely a bit of a roller coaster ride for sure.
I mean, the S&P 500 down almost 14% since the year started, as of last Monday at least. That kind of news, it can make anyone a little hesitant.
Absolutely. It's natural to feel that way when things are so unpredictable. Makes you want to just kind of hunker down and wait for the storm to pass.
But, and here's where it gets really interesting for today's deep dive. What if this volatility could actually be a huge opportunity? Especially if you're the owner of a privately held, mid-market company.
Okay, I'm intrigued. Turning uncertainty into an advantage. How do we do that?
Well, we're going to pull some serious insights from this article by Darrell Amy. Market volatility creates mid-market opportunity. How to capitalize now. It's packed with actionable steps you can use to not just survive this, but maybe even come out ahead.
All right, so we're not just talking about weathering the storm. We're talking about actually using it to propel ourselves forward. I like the sound of that.
Exactly. And the whole mindset shift here is, instead of getting paralyzed by fear or uncertainty, we're going to focus on proactively building value in your business. And I love this quote from A Business Owner's Guide to Maximize Business Valuation, which Amy's article references. The ultimate goal of every business owner should be to maximize value, not just profit. And I think that's super important to keep in mind as we go through this.
Yeah, that really hits the nail on the head. It's not just about short-term gains. It's about building a business that's strong and attractive, regardless of what's happening in the wider market.
Right. So Darrell Amy outlines 3 big ways that this market volatility could actually create advantages for mid-market companies like yours. And those are what we're going to dig into today.
Let's hear them. Lay them on me.
We're going to look at why capital might actually be seeking out private markets like yours right now, looking for safer ground. Then we'll dive into how the potential for lower interest rates could be a serious lever for growth. And finally, we'll talk about how strategic acquisitions and integrations, even reshoring, which is a big topic these days, can create some really unique opportunities in this kind of environment.
Wow, that's a lot to unpack, but it sounds like it could be some really valuable information, especially for business owners who might be feeling a little uncertain about the future.
Exactly. So let's jump right into that first point.
Yeah.
Why is capital seeking safety in private markets? What makes companies like yours so attractive right now?
All right, so imagine you're sitting on a pile of cash. You're an investor, right? And the stock market's going haywire, up one day, down the next. It's enough to make anyone seasick.
Yeah, I wouldn't want to be on that boat right now. What would make me feel more confident about where to put my money?
Exactly. You'd want something stable, predictable, something
Yeah.
you understand. And that's where your privately held, profitable mid-market business comes in, especially if you have a history of steady revenue, a good management team. Those are signs of stability that investors crave when the public markets get rocky.
So it's like in times of chaos, everyone wants to go back to the basics, back to something tangible, something real.
Exactly. It's like comparing investing in a volatile tech startup to buying a well-maintained apartment building. The apartment building might not have the same explosive growth potential, but it offers a sense of security and predictable returns that feel a lot more appealing when everything else is up in the air.
Right, so steady and reliable wins the race when the ground is shaky under everyone's feet. Now, Amy's article also mentions this interesting trend of retired business owners becoming more active investors. Why is that?
That's a really interesting point, and I think it has to do with experience. These are folks who've built and sold their own businesses, so they know the ins and outs of private companies. They understand what it takes to succeed in that world, and they're often more comfortable investing in something they know rather than trying to navigate the complexities of the public markets.
So it's like they can see beyond the numbers and really understand the inner workings of a business like yours.
Exactly. They can look at your track record, your team, your market position, and make an informed assessment of your potential. And that kind of insight is incredibly valuable in uncertain times.
Okay, that makes a lot of sense. So we've got these investors looking for a safe haven, and they're finding it in mid-market companies.
Yeah.
But what kind of investors are we talking about here, and what are they looking to do with their money?
Well, Amy outlines a few different types. You've got your passive investors, who are mainly seeking steady returns without getting their hands dirty in the day-to-day.
Right, kind of like a silent partner.
Exactly. Then you have strategic investors, who might bring more than just money to the table. They might have valuable industry connections, expertise, things that could really help you grow.
So they're not just looking for a return on investment, they're also looking for synergies and growth opportunities.
Exactly. And then you've got private equity firms or other partners who might be interested in growth equity investments or maybe even a recapitalization that could give you some liquidity while letting the business keep running.
Okay, so a whole range of potential players, all looking at mid-market companies like yours with renewed interest. So what's the first thing I should do as a business owner to make sure I'm ready for this influx of potential investors?
Well, Amy uses this phrase, and I think it's really key.
Yeah.
You need to position your business as investable. That means going beyond just having good numbers. You need to be able to tell a compelling story about where your company has been, where it is now, highlight those consistent revenue numbers or customer retention rates, and where it's going in the future.
Okay, so a good narrative, a clear vision for the future. But what about the nitty-gritty, the financials?
Absolutely crucial. Your financial house needs to be in order. Clear, accurate, readily available records, that's non-negotiable. Investors need to see that you're a stable, well-managed company. They want that reassurance, especially in a volatile market.
So the story and the numbers have to work together to paint that picture of a solid, reliable opportunity.
You got it. It's about building trust and demonstrating that you're a good bet, even when things are uncertain.
All right, so we've talked about how capital is flowing towards stability and how that creates a unique opportunity for mid-market businesses. Now, let's talk about another potential advantage in this environment. Lower interest rates.
Yeah.
That always sounds good, but how does market volatility actually lead to that?
Well, when the market's doing the jitterbug, it tends to make central banks, like the Federal Reserve here in the U.S., a little nervous. Their job, in part, is to keep the economy stable. And lower interest rates can be a tool to do just that. It encourages borrowing and investment, which can help stimulate things when they slow down.
Okay, so the Fed might lower rates to try and calm things down, and that could actually be good for my business.
Hmm.
But how exactly does that translate into real benefits for me?
Here's the direct impact. Lower interest rates mean it becomes cheaper for you to borrow money. And as Amy quotes from A Business Owner's Guide to Maximize Business Valuation, a company with a higher value represents a lower risk to a lender. The company with a higher value, therefore, should be able to get a lower interest rate on debt.
So my already valuable mid-market business becomes even more attractive to lenders because the overall cost of borrowing goes down.
That's it. And that opens up some real strategic possibilities.
Like what? Give me some concrete examples of how I can use this to my advantage.
Well, first off, if you've got any existing high-interest debt, now could be a great time to refinance. Even a small drop in your interest rate can save you a lot of money in the long run, freeing up cash flow.
Yeah, that makes a lot of sense. Pay less on the old debt and free up some room to maneuver.
Exactly. And then there's the potential for acquisitions. Lower interest rates make it more affordable to borrow money to acquire another company, maybe a competitor, maybe a company in an adjacent market. That can really help you expand your reach and your market share.
So use that cheaper capital to get bigger and stronger.
Exactly. And of course, there's always the option of investing in growth initiatives within your own company, upgrading technology, expanding your marketing efforts, whatever you need to do to move the needle forward. And lower interest rates make those investments more appealing.
It's almost like a window of opportunity opens up. Like you could be more ambitious with your plans without taking on as much risk.
I think that's a great way to look at it. It's about being strategic and capitalizing on the conditions that are out there.
All right, so we've talked about capital seeking safety. We've talked about the potential upside of lower interest rates. Now, the third big area Amy's article discusses is acquisitions, integration, and this idea of reshoring. It feels like a whole other level of complexity. Where do we even begin with that?
It's definitely multifaceted, but the underlying principle is that uncertainty can actually create some really interesting opportunities if you know how to play your cards right. For example, Amy points out that when smaller business owners are facing a potentially shaky economic future, some of them might actually be more willing to sell. They may not have the resources or the stomach to weather a prolonged downturn.
So their hesitation could actually be my chance to grab up a business that makes strategic sense for me. But what kind of acquisitions should I be considering?
There are a few angles to consider. You could look at buying up competitors to solidify your position in the market. That could give you more pricing power, eliminate some competition, and maybe even lead to some cost savings through consolidation.
So kind of like strengthening your core.
Exactly. Or you could look at expanding into adjacent industries, adding new products or services that complement what you already offer. That can help you diversify your revenue streams and reach new customer bases.
So spreading your wings a bit, exploring new territory.
Right. And then there's the regional roll-up strategy, where you acquire smaller players in different geographic areas. That's a great way to expand your footprint without having to build everything from scratch.
Okay, those are some great targets to keep in mind. Now, the article also talks about reshoring. How does that fit into all of this? It seems like it's driven more by global supply chain issues than market volatility.
You're right, reshoring is definitely tied to the disruptions we've seen in global supply chains. But market volatility adds another layer of complexity, and it might make reshoring even more attractive for some companies.
So, explain that connection for me. Why is reshoring suddenly becoming such a hot topic?
Well, over the past few years, we've seen how fragile global supply chains can be. Pandemic lockdowns, port congestion, political instability. It's been a real wake-up call for a lot of companies. And when you layer on top of that the uncertainty of a volatile market, it makes those risks even more concerning.
So, suddenly having your production closer to home starts to look a lot more appealing.
Exactly. And when you combine reshoring with vertical integration, meaning you take more control over different stages of your supply chain, the benefits can be even bigger.
Okay, so paint me a picture here. What are some of those tangible benefits of bringing things back home and taking more control?
Well, first off, you gain more control over quality. You can set the standards, you can oversee the processes. You're not relying on someone halfway across the world to meet your specifications. That can be a huge differentiator in the market, especially if quality is a key selling point for your products.
So, more control, better quality, what else?
You also gain more control over timing. No more waiting for shipments to clear customs, no more worrying about delays at ports. You can be more agile and responsive to customer demand, which can be a huge competitive advantage.
And I imagine it also reduces a lot of the geopolitical risk that comes with relying on overseas production.
Absolutely. If your supply chain is heavily dependent on a particular country or region, any kind of political instability or trade dispute can really throw a wrench into your operations. By bringing things closer to home, you minimize that exposure.
Okay, so more control over quality, timing, and risk. Those are some pretty compelling reasons to consider reshoring. But how does all of this translate into actual value for my business? How does it impact my bottom line and my overall valuation?
Amy connects this back to his value creation engines framework, which is a really useful way to think about this. Reshoring and vertical integration feed directly into what he calls the strategic innovation engine. By creating a more secure and reliable supply chain, you can potentially speed up product development, get to market faster, be more flexible with customization. All of that creates new competitive advantages that can really boost your value.
So it's not just about saving money on production costs. It's about creating a more agile and innovative business that can respond to market demands faster and more effectively.
Exactly. And it also impacts the process optimization engine because you're streamlining your operations, reducing complexity, improving efficiency throughout your entire value chain. And all of that contributes to a higher enterprise valuation.
So reshoring might sound like a big, complex undertaking, but when you look at it through this lens, it starts to make a lot of sense as a strategic move.
Especially in a market environment where agility and resilience are more important than ever.
This has been a really eye-opening conversation. Now, I'm sure our listeners are wondering, what can I actually do right now to take advantage of all this? Where do I start?
Amy's article is great because it really lays out some concrete steps you can take. And the very first one, the most crucial one, is to know your business value.
Okay, that makes sense. But why is knowing my valuation so important, especially right now?
Because it's the foundation for everything else. The article even breaks down a simplified valuation equation. Your value equals your recast EBITDA times your industry multiple. That's a really simplified way of looking at it, but it illustrates the point.
So understanding where I stand today is crucial for making smart decisions about the future.
Exactly. Whether you're thinking about attracting investors or making acquisitions or even just navigating the next few years, knowing your current valuation is essential. It helps you assess opportunities, negotiate from a position of strength. It gives you a clear benchmark.
And the article highlights a pretty startling statistic about this, right?
Yeah.
Something about how many businesses actually have a recent valuation.
It is pretty surprising. It says that only 40% of mid-market companies have had a valuation done in the last 3 years. So that means there are a lot of businesses out there operating without a clear understanding of what they're actually worth in today's market.
Wow, that's a lot of businesses flying blind, so to speak.
Yeah.
So step one is definitely getting that valuation done. And the article mentions something called the Value Creation Engine's MAX process. What's that all about?
The MACIS process is Amy's framework for proactively building value in your business. It's an acronym, MAX. Measure, accelerate, and then expand, exit, or exchange. It all starts with knowing where you stand. That's the measure part. Then actively working to increase your value. That's accelerate. And finally, deciding what you want to do with that increased value. Expand the business, exit through a sale, or explore strategic exchanges like mergers or acquisitions. But it all starts with that initial evaluation.
Okay, so know my value. Got it. What's the next step?
The next step, according to Amy, is to call a strategic summit. Get your leadership team together and really dig into the big picture.
I imagine that takes some serious commitment, pulling everyone away from their day-to-day responsibilities. Why is that so crucial right now?
Because, as Amy puts it, this isn't business as usual. The level of volatility we're seeing demands a deeper level of strategic thinking. It's not just about making minor adjustments, it's about potentially rethinking your entire approach.
So what kind of questions should we be asking ourselves during this strategic summit?
Well, the article recommends revisiting those fundamental questions that Peter Drucker, the famous management consultant, used to ask. What is our business? Who is our customer? What does the customer value? It seems simple, but forcing yourself to answer those questions honestly and in the context of today's market can be really powerful. It can help you uncover blind spots, challenge assumptions. It can even lead to entirely new opportunities.
So it's like taking a step back and reevaluating your whole reason for being. And I imagine that can be pretty uncomfortable, especially if you've been successful doing things a certain way for a long time.
It can be challenging, but it's also incredibly valuable. And it's not just about rehashing the old answers. It's about looking at the changing market, identifying new risks and opportunities, and figuring out how to use those value creation engines we talked about to maximize your potential.
So it's a time for deep strategic thinking, not just tactical adjustments.
Exactly. And Amy really stresses the importance of giving this process the time and attention it deserves. Don't rush it. Don't try to squeeze it in between other meetings. Carve out the space for real, thoughtful discussion.
All right, so I get my evaluation, I have my strategic summit, and then what? What's the third and final actionable step?
The third step is to grow with intentional action. That's where you take all the insights from your strategic summit and turn them into concrete plans and initiatives.
Okay, but how do I make sure those plans are actually effective? How do I translate all that strategic thinking into real results?
Well, Amy recommends using the output of your summit to refocus your value creation engines, figure out which levers you need to pull to drive the most growth, and then set specific goals and metrics to track your progress. He's a big fan of OKRs, objectives, and key results as a way to set ambitious but achievable goals that are tied directly to your overall valuation.
So measurable goals, clear accountability. That makes sense.
Exactly. And to build momentum, Amy suggests implementing what he calls 90-day value creation sprints. Focus on a few key initiatives, put all your energy into them for 90 days, see what works, adjust, and then repeat.
So a more agile, iterative approach to growth. I like that.
And when it comes to specific growth actions, Amy highlights the power of what he calls a dual approach to revenue growth. That means focusing on both acquiring new customers and finding ways to sell more to your existing customers through cross-selling and upselling.
So new blood and deeper relationships with the customers you already have. It's like a 1-2 punch.
Exactly. And the article quotes some research that shows companies that do both of these things well, they see exponential revenue growth. It's a really powerful combination.
So as we wrap up this deep dive, I want to make sure I've got the big picture right. We started by talking about how unsettling all this market volatility can be, but what I'm hearing is for mid-market businesses like ours, this could actually be a time to make some really strategic moves.
That's the key takeaway. The market might be uncertain, but that uncertainty creates opportunities. And by focusing on value creation, on building a strong, resilient business, you can not only survive this period, but potentially come out of it even stronger.
And the 3 key areas to focus on are attracting capital that's seeking stability, taking advantage of potentially lower interest rates to fuel growth, and strategically exploring acquisitions and reshoring to build a more robust and competitive business.
Exactly. And for you, as the listener, the most important thing you can do right now is to understand your business's value. Get that valuation done, and then bring your team together for a deep dive into your strategy. Those are the first steps to unlocking the potential that exists in this market.
So as you're thinking about all of this, here's a final question for you to ponder. What assumptions have you been making about your business, your market, your customers that might no longer be true in this changing landscape? What if some of those seemingly safe assumptions are actually your biggest vulnerabilities? And even more importantly, how could challenging those assumptions, how could proactively addressing those potential weaknesses actually unlock unforeseen growth and create a more resilient and variable business. That's something to think about as we conclude this deep dive. Thanks for listening.
Thanks for having me.